I was just muting CNBS because they told you the labor market is strong, and the market rallied last Friday because the jobs number was better than expected. And I guess it was better than expected. It's about 40,000 jobs less than the average of 2024, but it was better than expected. So I guess you should all run off and get over ebullient about the stock market, which is trading at over 200% of GDP once again. So the labor market is cracking, and I want to just finish that, just wrap up that thought. I just want to also mention that. So there's two surveys. There's an establishment survey and a household survey. Well, the establishment survey beat the number by a little bit, as I just mentioned, but the household survey showed that there was almost 700,000 jobs lost in the May jobs report. And the labor force shrank by almost 700,000. And the number of continuing jobless claims is the highest level now since November of 2021. So the economy is slowing, liquidity is draining, the labor market is fracturing, but at the same token, there's an awful lot of optimism about the fact that the level of tariffs went from 145% on China to 30%. And there's an awful lot amount of optimism about this extension of the Tax Cut and Jobs Act. So there's a lot of optimism, but underneath the foundation is fracturing. I remain net long the stock market in the correct sectors, which include precious metals, but I am more vigilant now than I've been for a very long time as to when this model that I created is going to signal for me to get more defensive, because it can't be much longer. Well, the larger trend is that the labor force is shrinking. So you have deportations. I think Trump just got authorization to remove 500,000 people from the United States. And the border is, for the most part, closed. So on a rate of change basis, the demographics are all upside down now, which listen, I'm all for controlling the border. I'm just saying that the labor force growth is one half of the input to GDP. So you have productivity growth and you have labor force growth. Well, the labor force isn't growing, it's shrinking. The calculation was that there was 70% of all Biden's employment were government-related jobs, either directly working for the government or contractors to the government. So that's over with, that's gone. So yeah, that's why we're seeing a lot of stress on the consumer. The fact that we look at pressures on inflation. The tariff level is going to be, even if it stays where it is, doesn't go any higher, doesn't go any lower. Trump says, and Besson says, and Lutnick says that the tariffs aren't going away completely because they love that revenue that's coming in. So it's going to be 6 times higher than it was in last year. And then you add on top of the fact that inflation is just not going anywhere near 2%. So I'm talking about the level of inflation has destroyed the middle class of this country and down. And the fact that inflation is only growing at 2.4% now, it's growing at a rate that's above where they can sustain their standard of living. And it's also growing at a rate that's higher than the Fed's target of 2%. And the fact that we just have oil shot up by, 8% this morning is not going to help the calculation. So tariffs have yet to kick in. That's going to add to price shock. I don't consider it inflation. And then you have the energy increase on top of that. So not going to get any relief anytime in the near future. And you add on top of that the fact that the Fed absolutely cannot lower interest rates at this point. Because even though they would like to do it, and I think they will do it, especially when Powell gets replaced in 2026 by some version of Al Capone, right now the Fed is holding their ground because inflation is not down to their target level. And there's a reason to believe it could be headed even slightly higher than it is right now, for what I just mentioned. In 1913, when you formed this creature called the Federal Reserve, one of their mandates supposedly was for stable prices. I consider stable zero. I consider stable prices not going up or going down. So that's the definition of stable. But somehow that got under Ben Bernanke, and in the zeitgeist of today, every central banker on the planet in the developed world says, yeah, 2% sounds like a good number to me. Even though we're not going to meet that number for 6 years, we're going to be above that number for 6 years. 2% is the new definition of stable. And the reason is clear. They just can't let asset prices fall because that's the assets that banks own. They own, mortgage-related debt for the most part. And if home prices fall, banks are going to become insolvent, run on banks, and then they stop lending and the economy crumbles. So they need to get stock prices growing. They need home prices growing, and they think that's going to lead to nirvana. But the fun thing happens, Bernanke was a 2007 phenomenon. So on the way to 2%, home prices didn't go up by 2%, they went up by 20%. And now no one could afford a house. So the first-time home buyers have been priced out of the market. And so if you can't get the first home buyer in there, then the second home buyer can't sell. And then, you have a frozen house. The transaction market is now frozen. So this is what happens when you morph from stable prices and sound money, which is a gold standard. You limit the base money supply to 2%, which is commensurate with the mine supply, about commensurate with the mine supply of gold, then you just eliminate all these bubbles. And by the way, stop bailing out banks. There could be a fractional reserve system, which is horrific in itself. But when you have a fractional reserve system and one of these banks goes amok and lends much more than they have in assets and liquidity runs dry, do not bail them out. Let them fail. And then we will not have any more inflation in this country. And we'll have a solvent and viable middle class, which is absolutely essential to a healthy country. It is a pipe dream. In fact, that's why they have something called the standing repo facility. We always had something called the discount window. So even in 1913, if you're a distressed bank, you can take your assets, which were always treasuries, and take them to the discount window, get a haircut on those treasuries, a discount on those treasuries, and you get a temporary loan. But now, forget about the discount window. Now we have the standing repo facility, which means if you have bad corporate debt, if you have a bad mortgage-backed security, a CLO, whatever your instrument is that's going bad, we'll just take it off your balance sheet for you and give you some credit, keep you afloat. So, this is the failure of a democratic republic. It's a failure of a free market capitalist system that we have. That's why we're talking about things like digital currencies, which is, I think, the precursor just to pave the way for a central bank digital currency. Right now, if let's say your bank at, say, Wells Fargo, and the central bank says, we are now going to charge you a negative interest rate on your deposits, and then we'll make it 5%, negative 5%. What would you do? Well, you would run to your bank at Wells Fargo, and you would say, okay, I want all my money out. I'm taking my physical currency out, and I'm stuffing it under my mattress because I don't want to lose 5% per annum. Thank you very much. Well, in a central bank digital currency, they have plenary control of your life. They see everything you buy, everything they sell. There's no more tax cheats, and I don't espouse tax cheating, but there's no more hiding. There's no underground economy. It's just that your money is in the bank, and thank you very much, negative 5%, we'll take it. Or if you don't like it, you could take your money out of the bank. No longer. You could only spend it. So you can't hoard money. So there's no more runs on the bank. In other words, it's complete and total control of your life. That is where we're heading. And that's why I think these digital currencies are paving the way. You're going to have a central bank digital currency, a Fed coin, whatever it is. And everybody's going to be happy about it. Oh yeah, wow, and electronic money, what do you do? We have to worry about making sure all the bills in your wallet are folded nicely, in ascending order, like an obsessive compulsive person like me. You can't do that. There's no more paper money. Digital coins, currencies have replaced all paper money. This is a very unusual situation where you had stress in the market. And usually when you have a fear of recession and the market starts to fall, what do people usually do? They usually buy a treasury, which is denominated in dollars. So dollars tends to rise. It's part of, if you look at the four horsemen of the economic apocalypse, which I would usually gravitate to in times of recession, depression, or when there's a market crash, well, one of those things is the dollar. Well, the dollar has been performing terribly in times of stress. And that's a huge red flag for me. That tells me that faith in our sovereign bond market is faltering. And if foreigners no longer have the desire to hold our bonds because of insolvency or because of inflation or just because there's no more trade surplus to recycle into dollars, that's a big warning sign. So when the solution isn't to own dollars and bonds, that's part of the problem. If you don't have a viable plan, you can be in a big world of hurt as far as your retirement is concerned. It's to become a risk asset. It's trading like a pink sheet stock. It being, and I'll be very specific, long duration treasury bonds. Okay, now I'm not talking about bills. All right, not even 1 to 3 year treasuries. They're very short end. That's what the Fed controls. And I think they're going to panic soon in 2026. Like I said, bring it back to what we were talking about, the labor market. The labor market is clearly fracturing right now. There's not much they can do about it now, but I think next year, especially when Trump replaces Powell with some version of Al Capone, the short-term rates are going lower. But when the Fed cut rates 100 basis points not too long ago, what happened to long-term bonds? They went down and yield went up. Okay, price went down, yield went up. And I think the same thing's going to happen next time. So if you're someone who's in a pension plan or hedge fund and you think you've grabbed a lot of solace or ballast or an offsetting function by grabbing long duration treasuries, you might be in for a shock. That might be the cause of your issue. That might be the nucleus of your problem going forward. I just did a deep synopsis of our debt situation. As a matter of fact, I was actually on the phone with a U.S. Senator's office, and I did a long dissertation on the state of our sovereign bond market. We could very well have $67 trillion of outstanding debts, currently 37, another 30 trillion added in the next decade. $30 trillion. Now, I don't know if I said this on your program before, but if I did, it bears, reiterating that it took 250 years to accumulate $37 trillion in debt. And we're going to do 30 trillion in 10 years. So the problem now, the nucleus of the next crisis is going to be, as it almost always is a problem in the credit markets. And in particular, is going to be not maybe mortgage-backed securities, although housing is in not great shape. It might very well be long-duration treasury bonds.